If you observe carefully how the Federal Reserve responded to every major financial crisis over the past 50 years, you'll see a consistent pattern that reveals something uncomfortable about how the monetary system actually works. This isn't conspiracy theory. It's documented policy that's been implemented repeatedly with predictable consequences for individual savers and investors. The Federal Reserve's primary mandate is officially to maintain price stability and full employment. But when you analyze their actual responses during crisis periods, their real priority becomes clear: preserving the banking system's stability regardless of the cost to individual Americans' purchasing power. Ray Dalio has often observed that understanding central bank incentives is crucial for protecting wealth because central banks don't optimize for individual wealth preservation. They optimize for systemic stability. According to publicly available Federal Reserve documents and policy statements, this distinction becomes critical during periods of financial stress. History teaches us that when forced to choose between protecting banks and protecting savers, central banks consistently choose banks. This isn't because they don't care about individual Americans. It's because they believe that bank failures would cause even greater harm to individual Americans than the alternative policies they implement. But for individual wealth protection, this distinction matters enormously. If you understand that Fed policy is designed primarily to benefit the banking system, you can position your wealth accordingly, rather than being surprised when Fed actions benefit banks at the expense of savers. The mathematical reality of Fed policy when the Federal Reserve cuts interest rates to near zero, as they did in 2008 and again in 2020. This creates what economists call a wealth transfer mechanism from savers to borrowers, primarily banks and highly leveraged institutions. According to institutional research on monetary policy effects, every 1% reduction in interest rates transfers approximately $300 billion annually from savers to borrowers in the U.S. economy. During the 2008-2015 period of near-zero rates, this represented a transfer of over $2 trillion from savers to the banking system. Most individual Americans are net savers. They have more money in savings accounts, CDs, and fixed-income investments than they have in variable-rate debt. This means that Fed policies designed to help banks systematically harm most individual Americans' financial positions. The mathematics are straightforward but rarely discussed in mainstream financial media. When the Fed cuts rates to help banks, it reduces the returns available to savers while reducing the costs paid by borrowers. Since banks are massive net borrowers and most individuals are net savers, this directly transfers wealth from individuals to banks. Ray Dalio's analysis of monetary policy has consistently emphasized that individual investors need to understand these transfer mechanisms because they're predictable and persistent. They're not temporary side effects. They're the primary mechanism through which Fed policy operates. The 2008 blueprint. Banks first, everyone else second. The 2008 financial crisis provides the clearest example of Fed priorities in action. When major banks faced insolvency due to their own risk-taking decisions, the Fed's response was immediate and overwhelming. Near-zero interest rates, quantitative easing, and direct bailouts totaling trillions of dollars. According to publicly available Fed documents from this period, the rationale was that bank failures would create systemic collapse that would harm everyone. This rationale wasn't wrong. Bank failures would indeed have created massive economic damage. But observe what happened to individual Americans during this same period. Savers saw their returns collapse to essentially zero. Retirees depending on CD income saw their monthly income fall by 70 to 80%. Anyone holding cash or short-term investments watched their purchasing power erode as the Fed's policies created asset price inflation. Meanwhile, banks benefited from multiple mechanisms simultaneously. They could borrow from the Fed at near-zero rates. They received direct capital injections, and the Fed's quantitative easing policies inflated the value of their bond holdings. The mathematical result was that banks recovered their losses within 2 to 3 years, while individual savers experienced a decade of near-zero returns on safe investments. This was not an accident or an unfortunate side effect. It was the predictable result of policies designed to transfer wealth from savers to banks. The 2020 acceleration, the same pattern, amplified the Fed's response to the 2020 pandemic, followed the same blueprint, but with even greater magnitude. According to Federal Reserve data, they expanded the monetary base more in 2020 to 2021 than in the entire previous history of the institution. Interest rates went to zero again. Quantitative easing was implemented at unprecedented scale. The Fed even began purchasing corporate bonds directly, something they had never done before. Emergency lending facilities were established to ensure banks had unlimited access to funding. For individual Americans, the pattern repeated, but more severely. Safe savings rates fell below inflation, creating guaranteed purchasing power losses for anyone holding cash. Asset prices inflated dramatically, making housing, stocks, and other investments less accessible to new buyers. But for banks, the benefits were extraordinary. According to banking industry reports, 2021 was one of the most profitable years in banking history. Banks could borrow unlimited amounts at near-zero rates while lending at higher rates and investing in appreciating assets. The wealth transfer was even more dramatic than in 2008. Macroeconomists estimate that Fed policies during 2002-02 transferred over $4 trillion from savers and wage earners to asset holders and the banking system. The structural incentive problem, according to institutional analysis of central banking. The reason this pattern repeats consistently isn't because Fed officials are intentionally trying to harm savers. It's because of structural incentives that make this outcome nearly inevitable. Bank failures create immediate, visible crisis that generates political pressure on Fed officials. The failure of a major bank makes headlines, triggers congressional hearings, and can end careers of central bank leaders. But the gradual erosion of savers' purchasing power through low interest rates and inflation is largely invisible. It happens slowly, it's difficult to measure precisely, and it doesn't generate the same political pressure. Ray Dalio has observed that this incentive structure means that Fed officials will consistently choose policies that prevent immediate banking crises, even if those policies create long-term harm to savers and the broader economy. This isn't a criticism of Fed officials personally, it's an analysis of how institutional incentives shape behavior. Given the choice between visible, immediate crisis bank failures and invisible, gradual harm purchasing power erosion, institutions predictably choose to prevent the visible crisis. The information asymmetry. One reason most Americans don't understand these dynamics is information asymmetry. Banks and institutional investors have teams of economists who analyze Fed policy implications immediately when they're announced. They understand exactly how different policies will affect their profits and adjust their strategies accordingly. Individual investors typically rely on mainstream financial media, which often presents Fed policies as measures to stimulate the economy rather than analyzing their specific distributional effects. According to research from financial communications studies, Fed policy announcements are typically covered in media as either good news, stimulus, or neutral news technical policy. The specific mechanisms through which these policies transfer wealth from savers to banks are rarely explained clearly. This information gap means that banks can position themselves to benefit from Fed policies while individual investors often don't understand why their savings returns disappear or why their purchasing power erodes. Professional wealth managers who understand these dynamics adjust their strategies accordingly. But individual investors following mainstream advice often maintain exactly the positions cash, CDs, savings accounts that are most harmed by Fed policies. The currency debasement mechanism beyond direct interest rate effects. Fed policies create what economists call currency debasement, the reduction of purchasing power through expansion of the money supply. According to monetary theory, widely cited by institutional investors, When central banks create large amounts of new money, as the Fed has done repeatedly, this money doesn't distribute evenly throughout the economy. It enters through the banking system first. Banks receive this new money at essentially zero cost and can use it to purchase assets before prices adjust upward. By the time this new money reaches ordinary Americans through higher wages or increased economic activity, prices have already risen to reflect the increased money supply. This creates what economists call the Cantillon effect. Those closest to the source of new money benefit, while those furthest from the source are harmed. Banks are always closest to the source of new money. Individual savers are typically furthest from the source. Ray Dalio's research on monetary cycles emphasizes that this effect is mathematically predictable. Every period of significant money printing benefits asset holders and financial institutions while harming people who hold cash or receive fixed incomes. The asset price inflation strategy. One specific mechanism through which Fed policy benefits banks while harming ordinary Americans is intentional asset price inflation. According to Fed policy documents, one stated goal of quantitative easing is to increase asset prices, thereby creating a wealth effect that encourages spending and investment. Fed officials have explicitly stated that they want stock and real estate prices to rise. For banks, this policy is enormously beneficial. Banks typically hold large portfolios of stocks, bonds, and real estate. When Fed policy inflates these prices, banks' balance sheets improve dramatically. But for ordinary Americans, especially young Americans trying to build wealth, this policy is devastating. To make stocks more expensive when they're trying to invest for retirement. It makes houses more expensive when they're trying to buy their first homes. It makes starting businesses more expensive because all assets required for business formation become more expensive. The mathematical result is that Fed policies systematically favor those who already own assets, primarily banks and wealthy individuals, while harming those who are trying to acquire assets, primarily young and middle-class Americans. The hidden tax on savers mainstream analysis often describes Fed policies as stimulus that helps the economy. But institutional analysis reveals that these policies function as a hidden tax on savers that funds subsidies to borrowers. According to research from monetary policy institutes, the zero-interest rate policies implemented since 2008 have cost American savers approximately $3.5 trillion in foregone interest earnings. This money didn't disappear. It was transferred to borrowers, primarily banks and highly leveraged corporations. For a typical retiree with $500,000 in savings, the difference between normal interest rates 4 to 5% and Fed-imposed rates 0 to 1% represents $15,000 to $20,000 per year in lost income. Over a decade, this represents $150,000 to $200,000 in wealth transfer from individual savers to the banking system. This transfer happens without legislation, without public debate, and without most people understanding that it's happening. It's implemented through technical monetary policy decisions that most Americans don't have the background to evaluate. Ray Dalio has observed that this hidden taxation of savers is one of the primary mechanisms through which modern governments finance their operations without raising explicit taxes. It's politically easier than raising taxes, but economically equivalent to taxing savers to subsidize banks. The banking industry's structural advantage. According to institutional analysis of the banking system, banks benefit from more Fed policies, not just during crisis periods, but continuously through what economists call regulatory capture, the alignment of regulatory institutions with the interests of the industries they regulate. The Federal Reserve System includes significant representation from the banking industry. Regional Fed banks are partially owned by member banks. Banking executives regularly move between banks and Fed positions. This creates structural incentives for Fed policies that benefit banks. This isn't conspiracy. It's open institutional structure. But it means that Fed policies are designed by people whose careers and networks are connected to banking industry success rather than individual saver success. Professional wealth managers understand this structural reality and position their clients accordingly. They don't expect Fed policies to benefit individual savers because they understand that Fed officials' incentives are aligned with banking system stability rather than individual wealth preservation. The international dimension. The pattern of central banks prioritizing banking systems over individual savers isn't unique to the United States. According to research from international monetary institutions, central banks worldwide have implemented similar policies with similar distributional effects. The European Central Bank, Bank of Japan, and Bank of England have all implemented negative or near zero interest rate policies combined with quantitative easing programs. In each case, the primary beneficiaries have been banks and governments, while the primary victims have been savers. This global coordination of anti-saver policies means that traditional flight to safety strategies, moving money to different currencies or different countries, provide less protection than in previous decades. Ray Dalio's global macro perspective emphasizes that when all major central banks implement similar policies simultaneously, individual investors need strategies that protect against systematic currency debasement rather than just domestic policy mistakes. The political economy of Fed policy. According to political economy research, one reason Fed policies consistently favor banks over savers is that banks have concentrated political influence, while savers have diffuse political influence. The banking industry spends hundreds of millions of dollars annually on lobbying and political contributions. They have teams of economists and policy experts who can engage with Fed officials on technical details of policy implementation. Individual savers, in contrast, are a diffuse group with minimal organized political representation. Most people affected by Fed policies understand the mechanisms well enough to advocate effectively for their interests. This political imbalance means that Fed policies reflect banking industry preferences much more than individual saver preferences, even though individual savers represent a much larger portion of the population. Historical patterns and future implications. Historical analysis reveals that the Fed's pattern of prioritizing banks over savers has accelerated over time. According to monetary historians, Fed interventions have become more frequent, more aggressive, and more explicitly beneficial to the banking system. The interventions of 2008 were unprecedented in scope. The interventions of 2020 were even larger. This suggests that future crises will likely produce even more aggressive interventions with even greater wealth transfer effects. For individual wealth protection, this pattern suggests that strategies dependent on Fed policies benefiting savers are likely to be unsuccessful. Strategies that assume Fed policies will benefit banks and harm savers are more likely to be effective. Ray Dalio's long-term perspective emphasizes that these trends represent secular changes in how monetary systems operate rather than temporary emergency measures. Individual investors should plan for continued wealth transfer from savers to banks rather than expecting a return to policies that benefit savers. Practical implications for wealth protection. Understanding that Fed policy systematically benefits banks while harming savers has practical implications for individual wealth protection strategies. Traditional safe investments, savings accounts, CDs, money market funds are systematically penalized by Fed policy. These investments provide returns below inflation during periods of Fed intervention, creating guaranteed purchasing power losses. Assets that benefit from Fed policy include those that banks typically hold: stocks, real estate, commodities, and alternative investments that appreciate when new money enters the financial system. This doesn't mean individuals should eliminate all safe investments, but it means understanding that safety in the traditional sense may actually represent systematic wealth erosion over time. According to institutional wealth management research, effective strategies during periods of Fed intervention typically include minimal cash holdings, diversified real asset exposure, and international diversification to reduce dependence on any single central bank's policies. The behavioral challenge. One challenge for individual investors is that Fed policies create psychological comfort while creating mathematical harm. Low interest rates feel like stimulus. Rising asset prices feel like prosperity. The harm to savers is gradual and often invisible. According to behavioral finance research, people typically don't adjust their strategies until harm becomes obvious and painful. But by that point, much of the wealth transfer has already occurred. Professional wealth management addresses this by focusing on mathematical analysis rather than psychological comfort. If Fed policy mathematically harms savers, professional managers reduce saver-like positions regardless of how those policies are presented in media or political discourse. Ray Dalio's principles-based approach emphasizes making decisions based on logical analysis of how policies actually work rather than how they redescribe or how they make people feel. The long-term perspective. From a long-term wealth protection perspective, understanding Fed priorities helps explain why certain strategies work while others don't during different historical periods. Strategies that worked well during periods of Fed restraint, 1980s, 1990s don't work well during periods of Fed intervention, 2000s to 2020s. Strategies that protect against Fed-induced wealth transfer are different from strategies that protect against traditional market volatility. According to historical analysis, periods of aggressive central bank intervention can last for decades. Japan has maintained near-zero rates for over 30 years. Europe has maintained negative rates for over a decade. This suggests that strategies for protecting against Fed-induced wealth transfer need to be sustainable over very long time periods rather than temporary defensive measures. The Fed will continue to save banks rather than savers because their institutional incentives make this outcome nearly inevitable. Individual investors who understand this reality and plan accordingly are more likely to preserve their wealth effectively than those who expect Fed policies to benefit them directly. History teaches us that central banks consistently prioritize systemic stability over individual wealth preservation. This is unlikely to change because it reflects fundamental institutional incentives rather than personal preferences of individual Fed officials. The choice for individual investors is whether to understand this reality and adapt their strategies accordingly, or to continue following approaches that assume Fed policies will benefit individual savers despite historical evidence to the contrary. This content represents educational analysis of Federal Reserve policy patterns and should not be considered personalized investment advice. All financial decisions should be made in consultation with qualified professional advisors who can assess individual circumstances and risk tolerance.